Raw business activity, factories churning, supply chains moving, is an inherently chaotic, subjective swirl of constant, unmeasured physical motion. To compare the performance of different companies, we need to measure that chaos. But without a strict framework, those measurements involve subjective guesswork. Accounting operates as an information protocol, filtering chaotic reality into a standardized format. The foundational architecture governing this system is the theory base of accounting. It relies on a strict formula, generally accepted accounting principles, or GAAP, plus basic concepts, plus institutional standards. Grasping these 13 specific rules reveals exactly how subjective, real-world actions are converted into a universally trusted mathematical model. Building a reliable financial information system starts by drawing a strict boundary around the specific entity being measured. The business entity concept dictates an enterprise is isolated from its owner. When an owner invests 100,000 rupees, that capital crosses a dividing line. Consequently, the system accords the investment as a liability, meaning the business now owes that money back. The second boundary is the money measurement concept, which acts as a strict data filter. A qualitative asset, like a strong relationship with customers, is rejected by the system because it cannot be objectively quantified. In contrast, a tangible action defined by currency, like purchasing furniture for 20,000 rupees, passes through the filter effortlessly, registering as hard data. These boundaries protect the ledger from emotional bias, guaranteeing that only quantifiable, entity-specific data enters the financial model. A business in motion presents a measurement problem. Operations run continuously and do not naturally pause to let you take a snapshot. Under the going concern concept, the system assumes the operational timeline of a business extends indefinitely into the future. To measure performance across an infinite timeline, the accounting period concept artificially slices that timeline into strict intervals, typically 12 months long. Time also introduces the challenge of fluctuating value. If a market is moving, how do you lock in an asset's permanent worth? This chart demonstrates how the cost concept solves this by locking assets into the ledger at their original purchase price. If land is bought for 5 lakh rupees, it stays recorded at 5 lakh rupees despite market volatility. Fixing time into strict periods and costs into original prices creates the stability required to analyze historical performance without the distortion of external market noise. The structural engine of the ledger requires absolute mathematical equilibrium. Visualizing the dual aspect concept establishes that every transaction triggers an equal and opposite reaction. If an owner introduces $50,000 in cash, that input simultaneously increases the asset column by $50,000 and the capital column by the exact same amount. This mechanism forms the double entry system, distinguishing modern accounting from older fragmented methodologies. Single entry records are suitable only for small operations. The double entry system, however, is the globally accepted standard because of its internal rigor. The dual aspect principle transforms the ledger into a self-checking mechanism. Any mathematical imbalance instantly signals an error in how reality was recorded. Watching raw cash exchange hands provides a flawed, misleading illusion of actual business performance and long-term financial health. This creates a strict division between the rudimentary cash basis, which records transactions only when physical money moves, and the preferred accrual basis of accounting. Under the revenue recognition concept, the system logs revenue the moment a service is delivered, independent of cash receipt. To maintain accuracy, the matching concept requires that expenses be paired to the specific revenue they generated within that identical timeframe. Powered by matching and recognition, the accrual system intentionally decouples financial data from raw cash flow to reveal the true economic reality of the enterprise. Even with a mathematical equation, the human element of recording data requires strict behavioral guardrails. The conservatism or prudence concept engineers the system to be inherently pessimistic. It demands that accountants anticipate all potential losses while predicting zero future profits. The objectivity concept establishes an evidentiary standard. No data enters the ledger without verifiable physical proof, such as an invoice, bill, or voucher. The materiality concept filters out trivial, distracting noise from the reports, while the full disclosure concept forces the exposure of any significant information that could alter a user's financial decision. Finally, the consistency concept dictates that an enterprise must use the same accounting methods year after year, ensuring long-term comparative analysis remains valid. These qualitative heuristics prevent management from manipulating the data, ensuring the finalized output remains an objective, defensible truth. These underlying axioms are what allow complex, multinational networks of financial data to remain internally consistent and globally comparable. But theoretical concepts do not naturally enforce themselves. They require binding institutional authority. This is the role of official accounting standards. Bodies like the Institute of Chartered Accountants of India issue explicit, non-negotiable rules to guarantee transparency and uniformity across industries. It brings us back to the core architecture, generally accepted accounting principles, governed by basic concepts, enforced by institutional standards. The theory base of accounting is the definitive translation engine, turning the chaos of human enterprise into a highly structured, universally reliable language of value.